Assalamualaikum and good evening to our Business Finance 2 lecturer, Madam Suhaiza binti Ismail. My name is Zulaikha and my matrix number is 2327570, and alongside my group mates today will be presenting about our group assignment. I will be continuing the presentation with question 1 under A, which is evaluate whether the proposal from Hutan Sdn Bhd and advise whether it is financially beneficial for Ehsan Sdn Bhd. In order for us to solve this question, first we will need to find the values in current situation and the values in situation with proposal with Hutan Sdn Bhd. So under current situation, the sales actually is already in the question, which is 26,750,000, and the average collection period is 45 days. To find ACP, we will take the value of sales, we divide by 360 and we times by 45, and that will give us the value of 3,343,750. The actual receivables are already in the question, which is 4,458,000, and the bad debts is 1% of sales, so we will get the value of 267,500 ringgit. For short-term financing, it is already stated in the question that it will be 5%. So to find the value, we will take the value of 3,343,750. We will times by 5%, and we will get the value of 167,188. To find total annual cost, we will take the value of bad debts and the value of short-term financing. So we take 267,500 ringgit. We will add by 167,188 ringgit, and that will give us the value of RM 434,688. Next, we will be moving onto the situation with the proposal with Hutan Sdn Bhd. Under ACP will be 35 days. So again, to find the value of ACP, we will take the sales, divide by 360, we will multiply by 35, and that will give us the value of 2,600,694 ringgit. To find difference in receivables, we will take the value of situation with proposal and minus with the current situation. So we take 3,343,750. We will minus by 2,606,694, and that will give us the value of RM 743,056 ringgit. To find bad debts, we will take 267,500. We will multiply by 30%, and we will get the value of 80,250. Difference in bad debts are calculated with 267,500, and we minus by 80,250, and that will give us the value of 187,250 ringgit. The financing cost, we will take 743,056, we will multiply by 5%, and that will give us the value of 371,053 ringgit. Next is under administrative cost. It is stated in the question, which is 50,000. So interest, we will calculate by 80%. We will times by 2,600,694, and we will get the value of 2,080,555. The factory service fee, we will take 26,750,000, which is the value from sales, and then we will multiply by 75%, and we will get the value of 200,625. Total annual cost will be 145,639, and we plus by 200,625, and we will get the value of 346,000 and 264. Under benefits, we will take 37,153, and then we will add by 187,250, and the 50,000, which is the administrative cost. That will give us the value of 274,403. So the net total or the net benefits, we will take 274 and 403, which is from the benefits. We will minus by 346,264, which is the total annual cost, and that will give us the value of negative 71,861. So for the conclusion for this question, it is not financially beneficial as the net total is a negative value. Therefore, Ehsan Sdn Bhd should not accept this proposal. Next, I'll be moving on to B, which is explain how Ehsan Sdn Bhd can assess the creditworthiness of potential customers before extending credit. Ehsan Sdn Bhd can use the 5 C's of credit, which is character, capacity, capital, collateral, and conditions. Ehsan Bhd can assess character by checking the applicant's record of meeting past obligations. Under capacity, ASAP Berhad can check the applicant's ability to repay the requested credit. Under capital is by checking the applicant's debt relative to equity. For collateral is by checking the amount of assets the applicant has available for use in securing the credit. And lastly, under condition is to check the current general and industry specific economics conditions. So for C is calculate the cash conversion cycle of Asas Berhad both before and after implementing the debt collection arrangement. Explain the significance of any change in the cash operating cycle to the company's working capital management. So to find this, we will need to calculate the cash conversion cycle, which is the AAI plus ACP minus APP. So before that, for average AAI is 50 plus 45 minus 45 days, and we will get 50 days. After that is 50 plus 35 minus 45 days, and we will get 40 days. The CCC reduces from 50 days to 40 days, making it a reduction of 10 days. This also means that Ehsan Berhad can recover cash faster from its operation. Shorter CCC means that it could improve liquidity, lower the financing and default risk, and reduces the reliance on short-term financing. This improvement strengthens the working capital management efficiency. For the last question under D is interpret the accounts receivable age schedule of Ehsan Sender Berhad and recommend two practical actions to improve the collection process. So it is given for age of receivables, which is current, which is 0 to 30 days, and then 31 to 60 days, 61 to 90 days, and over 90 days. The amount for current is 1.8 million, for 31 to 60 days is 1.2 million, for 61 to 90 days is at 950,000, and the over 90 days are 508,000. So to interpret this, we will have to find the percentage first. So to find the percentage, we will take the value of amount, which is 1.8, we will divide by total, which is 4,458,000, and then we will multiply by 100%, and that will give us approximately of 40%. And then for 31 to 60 days, you will take 1.2 million, you divide by 4,458,000, you multiply by 100%, and that will give you approximately of 27%. For 61 to 90 days, it is 950,000 divided by the total, and then you will multiply by 100%, and you will get approximately of 21%. For over 90 days, we will take 508,000 divided by the total, multiply by 100%, and we will get approximately of 11%. So the interpretation is approximately around 40% of receivables that are current, which is 0 to 30 days. This means that only a small portion of our customers that are available to pay on time. So approximately 27% falls in the 31 to 60 days category, which means that there is delay and is beyond the normal credit terms. Approximately 21% from the category of 61 to 90 days actually suggests that there is weak credit control, and there will be a high risk of bad debts. Two recommendations are to improve the effort as well as strengthen the credit control and monitoring.
Moving on to the set 1 question 2. For the part A, total with dividend, we get 36 million, which is 1.2 multiplied by 30 million. For the retained earning, we minus net income and dividend, 60 million minus by 36 million, we get 24 million. For the equity needed, 60% times by 50 million, we get 30 million in total. For the available amount is 24 million, but the equity required is 30 million, which is short with 6 million. For the question B, total dividend is 36 million. New dividend is 36 million. We divide by 30 million, which will get 1.2, which is same as current proposal. As for benefits, it's align rewards and performance and also simplifies the planning. As for the drawbacks, it will have the dividend volatility and also reduce the internal funding.
So now I'll be continuing with the C part, which firstly we have to calculate equity. Equity is 60 times 50 million, which is 30 million, and retained earning is 36 million, and we have to divide it with 30 million. We'll get 1 DPS. And if we go through the implications for shareholders, there are few positive and negative implication. The first positive one is more funds retained for growth. Before it was 24, now 30 million. So potentially increasing future share value. And negative implication is that it lower immediate income. Firstly, we'll get 1 ringgit and afterwards 1.2. So this disappoint income focused investors. Overall, there is a shift focus from income to capital gains. This may attract growth oriented investors. And in the next session, which is D, relevance of M&M theory in Malaysia. There are three main relevance, which are: first one is information asymmetry. In emerging markets, insiders have more information. Dividends serves as a credible signals of financial health. Second one is clientele effect. Here, different tax treatment of dividends versus capital gains influence investors' preference. For example, retiree prefer dividends. Thirdly, market imperfections. Illiquidity, high transaction cost, and behavioral biases make dividends relevant for reducing agency cost and meeting investors' expectation.
My name is Nabihah Binti Mohammed Hairuddin, and I will explain to you for set 1 question 3. Before the merger, Satria Berhad has a net income of RM25 million and 10 million shares outstanding, resulting in an earnings per share of RM2 ringgit and 50 cents. Under the proposed acquisition, Satria Berhad will offer 1.2 of its own shares for every one share of Tegas Sendirian Berhad. Since Tegas has 4 million shares outstanding, Satria will issue an additional 4.8 million shares, bringing the total number of shares after the merger to 40.8 million. In terms of profitability, Satria Berhad and Tegas Sendirian Berhad generate a combined net income of RM33 million before synergies. The merger is expected to produce annual synergies of RM5 million, which after tax amount to RM3.8 million. As a result, the total post-merger net income is RM36.8 million, and when divided by the enlarged share base, the post-merger earnings per share is RM2 ringgit and 49 cents. Compared to the pre-merger earnings per share of RM2 ringgit and 50 cents, this indicates slight earnings per share dilution for Satria Berhad shareholders. This dilution is largely attributable to the premium implied in the offer made to Tegas Sendirian Berhad shareholders. Based on Satria Berhad's market price of RM30 per share, the implied offer value for each Tegas share is RM36. This results in Satria Berhad having a price-to-earnings ratio of 12 times, while Tegas Sendirian Berhad is being acquired at an implied price-to-earnings ratio of 18 times. Since Satria is acquiring Tegas at a higher earnings multiple, Satria's shareholders experience short-term dilution. However, this may be justified by the strategic benefits of entering the technology sector and the potential for future growth and enhanced profitability. In addition to the earnings impact, the merger also provides potential tax advantage. Tegas Sendirian Berhad has accumulated tax loss carry-forwards amounting to RM12 million at a corporate tax rate of 24%. The potential tax savings from utilizing these losses amount to RM2.88 million. Subject to regulatory approval and compliance with tax rules, these savings would reduce the merged company's future tax expense and increase post-tax income and cash flows. This tax benefit improves the overall value of the merger and helps to partially offset the earnings dilution faced by Satria Berhad shareholders. Finally, tegas sendirian berhad may adopt several defensive strategies to protect itself from a hostile takeover if the merger with Satria Berhad is delayed. One such strategy is the White Knight defense, whereby Tegas seeks a friendly acquirer to counter a hostile bidder and secure better terms for its shareholders. Another strategy is the poison pill defense, which allows existing shareholders to purchase additional shares at a discount if a hostile acquirer gains a controlling stake, thereby diluting the acquirer's ownership and making the takeover more costly. Lastly, the gas may implement golden parachute arrangements that provide generous compensation to key executives in the event of a takeover, increasing the overall acquisition cost and discouraging hostile bids.
Okay, so I will continue with set 1 question 4, the key characteristic of bond, option and also stock purchase warrant. So for a convertible bond is a debt instrument with fixed coupon. For this question is 4% annually, and it's mature in a fixed period, which is 5 years, and can be converted into 160 ordinary shares, and giving the investor both the security of fixed income and the potential upside if the company's share price is rise. For option, it has two. Basically, it has a call option and also put option. For call option, it gives the holder a right, not an obligation, to buy share at a fixed strike price, which is 6 ringgit, within a short period of 3 months. While a put option is basically give the right to sell share at a set price, 5 ringgit and 50 cent in this question, for the same period, but often used to hedge against a price declines. And for stock purchase warrant is similar to a call option, but it is issued by a company itself and typically has a longer maturity. For example, it has a 2 years of maturity, and the price is to buy the price per share at a predetermined exercise price, which is 6 ringgit and 20 cent. And the key difference between a stock purchase warrant and a call option is that a warrant is issued by the company, and it can create a new share when exercised, which may dilute existing shareholders. Whereas for the call option, are generally traded between the investor itself and do not affect the company's total share. Next, for question 4B, conversion price is basically calculated face value of bond divided by conversion ratio, which is 1000 divided by 60, and it's give a 6 ringgit and 25 for the conversion price. But for the conversion value is the current market price per share, which is 160 share times with 6 ringgit, it will give 960 ringgit. Since the bond face value is 1000, the conversion premium is 4.17%, and this premium basically represent the additional amount of an investor is paying to enjoy the dual benefits of receiving fixed coupon payment and the potential to convert into share if the market price rise or increase. In other words, the bond basically provide a downside protection through interest payments, but the investor will only profit from the conversion if the share price increase above the effective conversion price. Next, I will continue with the question 4C. For the investor which is expecting the price is to increase or to hit 7 ringgit in the next 3 months, basically for call option, the initial cost is 55 cent, which is more cheaper than stock purchase warrant. And the time horizon is basically for call option, it has a shorter period, which is 3 months, but the stock purchase warrant has a longer maturity, which is 2 years. And for the profit per share, for call option is only 45 cent. Then stock purchase warrant, which is only 10 cent.
and the ROI is for call option is 81.8% and stock purchase warrant is 14.3%. So basically when we see the difference between the call option and stock purchase warrant, the recommendation is basically to, of course, to choose a call option is more suitable for investment because it has a lower upfront and offers a much higher leverage, which is 81.8%, rather than stock purchase warrant that has only ROI is 14.3%. Since the investor only cares about the next 3 months, which is in a shorter period, so they should not pay the higher time premium associated with the 2 years warrant. So the call option is the most suitable investment for Emerald Berhad. Okay, next I will continue with the question 4D. Basically, what is the benefits and also risk of a hybrid or derivative instrument for both sides, for the issuer and also for the investor? Starting from the benefits, for benefit for the issuer or Emerald Berhad, basically it can lower financing costs because convertible bond usually carry a lower interest rate. In this question, it's give a 4% only than regular bonds because the conversion feature is valuable to the investor. And for the investor itself, what the potential benefit that can have is limited downside and also an unlimited upside. With option or warrant, the most an investor can lose is the premium paid. For example, in this question, we have calculated that the premium is only 55 cent. So they can gain the significantly if the stock is increase or skyrockets. But for the risk, the issuer, the Emerald Berhad, will have to incur the potential risk, which is dilution. If the stock price increase and everyone converted the share, the company must issue many new share, which is it will reduce in the EPS, the earning per share for existing owner. And for the investor, the risk is the time decay because unlike holding a stock, this instrument is expired. If the share price doesn't move before the expiry date, so the entire investment value can drop to basically can drop to zero. Okay, so for set 2, question 1A, basically we need to calculate the difference between sales, account receivable, and also the bad debts. So we can do the decision whether to change the policy or not. For sales, basically for the current sales, we have a 15,000 and the proposed sale is 15,000 and also 750 ringgit, which is this show that an increase of sale 750 ringgit, which is we will time with the contribution margin is 55%. So we will get the additional profit contribution from the sales for 4,125 ringgit. For account receivable, the average investment in the account receivable is the total variable cost divided by the turnover of account receivable. And because the current sales we have is 15,000 and the current account receivable is 45 over 360, because why we use 360, because it's stated in the equation that the period is 360 days instead of 365 days. So we will time 45 divided by 360 times with 15,000. So the proposed sales is 15,750 ringgit. So the proposed AR in 40% in 45 days is 10 over 360 times with 40% times with 15,750 ringgit. Another one is 60% in 45 days. 45 times with 360, which is 60 hundreds times 15 ringgit, 75 ringgit. And both total proposed account receivable is 1,356 ringgit 250. So we need to calculate the marginal investment of account receivable. A current account receivable will minus with the proposed account receivable. We will get the 580,750, which is it will give saving of marginal investment is 6% times with the marginal investment. So we will save around 31,125 ringgit. So for next is bad debt. The current bad debt is only 1%. So we will times with the current sales, we will get 150,000. For proposed bad debt, it decreases to only 0.5%. So it will give us 78,750, and saving of marginal bad debt will give 71,250. So whether we need to change the policy or not, we need to make the credit standard decision. So we will add the additional contribution from sales, saving of marginal investment in the account receivable, and also saving of marginal bad debt. Also, we will minus with the early settlement discount cost that had incurred in this question, and also the incremental cost, which is 2% from 1,575,000 ringgit, and we will get basically a net loss around 52,125 ringgit. So basically, Sabah and Berhad should not change its credit policy because from the calculation we can see it will give loss to the company. So the best decision is not to change the policy, but is to maintain with the current policy. For question B, the benefits give three benefits of offering an early settlement discount. The first one is improve liquidity and also cash flow. By encouraging customer to pay within 10 days instead of 45 days, the company receive cash must more sooner. So this reduce the reliance on expensive external financing like the bank overdraft. Next is reduction in bad debt risk. The longer a debt remains unpaid, the higher the change become uncollective, because a rapid payment basically it can minimize the window of time in which a customer might face a financial distress and also default. And three, lower administrative costs. This faster collection means the credit department spend less time and resources choosing overdue invoices, basically with sending reminder or initially legal recovery process. For question C, the average inventory is 1,200 ringgit and receivable conversion period is twice the inventory period. So we need to calculate the current and also the new AAI, ACP, APP, and also the CCC to basically to see whether the current on what the difference between the current and the new one. So for AAI, for the current is 45 days and the new one is 40% times with 10 plus 60% times with 45, we will get 31 days. For ACP, basically because it mentioned that receivable conversion period is twice the inventory period, so we need to divide it by 2. For current, 45 days divide by 2, we will get 22.5 days. And for new one, 31 divided by 2, we will get 15.5 days. And APP, basically it has the same APP, which is 30 days. And for DCC, we need to calculate. So for the current, we get 37.5 days, and for the new one is 16.5 days only.
Let's go to set 2 question 2. The first one is dividend irrelevance versus bird in the hand theory. So theory key proposition underlying arguments is dividend irrelevance, which is proposed by M and M. Here dividend policy does not affect firm's value. In perfect markets, investors are indifferent between dividend and retained earnings. Here the assumption is that there is no tax and no uncertainties in the market. And in the bird in the hand, investors prefer dividend now over future capital gains. A bird in the hand is worth two in the bush. Dividends are certain, capital gains are risky. So here people prefer more dividend than the future capital value. And in the B part, there are 3 reasons dividend policies matters. The first one is signaling hypothesis. Here, changes in dividend send signals about management's confidence in future earnings. And clientele effect. Here, different investors prefer specific dividend policies. Changing policy may alter shareholders' basis. And third one is agency cost reduction. Here dividend reduce free cash flow, limiting wasteful spending by managers. And the C part, residual dividend model calculation with corporate tax. So firstly we have to calculate equity, which is 60 times 800,000 is equal to 480,000. And by calculating dividend we can get 120,000. So in payout ratio we divide 120,000 by 600,000, which is 20%. So in D, we'll go through effect of lower net profit forecast. So if the profit is 500,000, then the dividend will be 500,000 minus 480,000. So it will be 20,000. And the payout ratio will be 20,000 divided by 500,000, which is 4%. Here it implies that dividend drop sharply, showing the volatility of residual value. And in E, we'll compare the advantage and disadvantage of residual policy. So in the advantage, we can ensure profitable investment are funded first, and it maximizes long-term shareholders' wealth. As a disadvantage, we can say the results is unstable and unpredictable dividends, which may dissatisfy income-seeking investors.
Moving on to question 3 of set 2. For part A, we divided table 5 with 500k, which will receive 2.1 of DOL. As for DFL, 500k divided by 400k, which resulted in 1.25, and the DCL 2.1 multiplied with 1.25, which will equal to 2.63. As for question B, the bond financing, the expansion cost is 400k. As for the interest, we multiply 14% with the 400k, which results in 56k. So for the income statement for bond, the sales is 25k, the variable cost 30% is 750,000. For contribution is 175,000. For fixed cost is 850,000. EBIT is 900,000, interest is 156,000, EBT is 744,000, tax, which is 40%, is 297,600, and also the EET is 446,400. So the shares remain 100,000. As for equity financing, they issued 10,000 shares at 30 ringgit, which will equal to 300k. For the income statement for equity, from sales to EBIT is the same as the bond. For the interest will be 100k, the EBT will be 800k, the tax is 320k, and EAT will result in 480k. Moving on to the part C, the DOL is 1.94, and DFL for bond financing is 1.21, and equity financing is 1.13. Meanwhile, the DCL for bond is 2.35 and DCL for equity and 2.19. As for part D, equity versus the debt financing, equity benefits is the lower financial risk, the low DFL and also the low DCL, because there's no fixed interest and more stable post-tax earnings. As for the debt risk, high fixed interest commitment, risk of financial distress if the sales drop. And for the equity drawback, it will be higher in cost than debt, lower EPS, and also the dilution of the ownership. So for the last question, part E is based on the M&M's theory. So that's divided into two, which is the without taxes and also the with taxes. Moving on to the case 1 with the without taxes first. The proposition 1 is capital structure does not affect the firm value. Value depends solely on operating income, the EBIT. As for proposition 2, as debt increases, financial risk arises because the cost of equity increases to offset the benefit of the cheaper debt. For the case 2 with corporate taxes, it plays a role as a tax shield because the interest is tax deductible and making the debt advantageous, and also the optimal structure. Firm value increases with leverage, optimal structure tends to the higher debt.
For set 2 question 4, I will present for part A, which is about valuing besi sendirian berhad using the discounted cash flow approach. Metal Berhad is considering acquiring besi sendirian berhad and the analysts have projected incremental net cash flow for 5 years. This cash flow occur at the end of this year and after year 5. The cash flow are expected to grow at a constant rate of 5%. First, we calculate the required rate of return using the capital asset pricing model or CAPM. The risk-free rate is 6%. The market risk premium is 4% and the post-merger beta is 1.2. Using the CAPM formula, the required rate of return is 6% plus 1.2 multiplied by 4%, which gives us 10.8%. Next, we discount the cash flow from year 1 to year 5 at 10.8% to obtain their present values. The total present value of these 5 years cash flow is RM 10.67 million. After year 5, the cash flow grow at a constant rate of 5%. So, we calculate the terminal value using the growing perpetuity formula. First, we find the cash flow in year 6, which is RM 4 million multiplied by 1.05, giving RM 4.2 million. Then, the terminal value at the end of year 5 is calculated as cash flow in year 6 divided by the difference between the required return and the growth rate. This gives a terminal value of RM 72.41 million. We then discount this terminal value back to the present value, which results in RM 43.36 million. Finally, by adding the present value of the cash flow from year 1 to year 5 and the present value of the terminal value, the total value of besi sendirian berhad to metal berhad is RM 54.03 million. Next, I will explain part B, which focus on warrants. High Investment purchased 50 warrants at RM 21 each 1 year ago and plans to exercise them today. Each warrant allows the holder to buy 2 ordinary shares at an exercise price of RM 35 per share. The current market price of the share is RM 50. First, we'll calculate the total cost. The cost of purchasing the warrants is 50 multiplied by RM 21, which equal RM 1050. The cost to exercise the warrants is 50 warrants multiplied by 2 shares multiplied by RM 35, giving RM 3,500. Therefore, the total investment cost is RM 4,550. Next, we calculate the market value of the shares received. Investment received 100 shares in total and at RM 40 per share. The total value is RM 4,000. Since the market value of the shares is lower than the total cost, high investment incur a loss. The loss is RM 4,000 minus RM 4,550, which equals RM 550. To calculate the rate of return, we divide the loss by the initial investment, which is the cost of the warrants. This gives a rate of return of negative 52.38%. This negative return indicates that exercising the warrant resulted in a financial loss.
I'll be continuing the presentation with part C of question 4. XYZ Berhad has convertible bonds outstanding that are callable at RM 1,200. The bonds are convertibles into 25 ordinary shares. The share is currently selling for 40 ringgit per share. So under A required, if the company announces is going to call the bond at 1,200, what actions are bondholders likely to take? Justify. So under this question, we will need to calculate the conversion value. So the convertible bonds is 1,200, market price is 40 ringgit. So bond convertible into 25 per share. So conversion value is we will take 25, which is bonds convertible into shares, and then we will multiply by market price, which is 40, and we will get the value of 1,000. So since the call price is 1,000 and the conversion value is 1,200, which is higher than which is higher. It would be much worse if the bondholders convert the bonds into shares. Bondholders are likely to accept the call and have their bonds redeemed at 1,200 rather than converting it. So for B, assume that instead of the call feature, the company has the right to drop the conversion ratio from 25 down to 20 after 5 years and down to 17 after 10 years. If the bonds have been outstanding for 4 years and 11 months, what will be the price of the bonds if the share price is RM41? Assume that the bonds carry no conversion premium. So conversion ratio from 25 to 20 after 5 years and from 20 to 17 after 10 years. The outstandings are 4 years and 11 months, which is before 5 years. So the current conversion ratio is still 25 per shares. So the bond price we will take 25 times by 41, which is the market price, and we will get the value of 1,025. For Part C, further assume that the share price is anticipated to rise to RM43.75 in 3 months. Considering the conversion features in Part B, should the bondholders convert now or continue to hold the bonds for at least 2 more months? So we will need to calculate the value if we convert now. So the current conversion ratio is 25 shares and the current share price is 41 ringgit. So the conversion value, we will take 25 times by 41, we will get 1,025. After 5 years, conversion ratio drops to 20 shares. So expected share price is RM43 and 43 ringgit 75 cents. So the future conversion value is 20 shares. We multiply by the expected share value and we will get RM 875. So the conclusion, bondholders should actually convert now. Although share price is expected to increase, the reduction in the conversion ratio from 25 to 20 shares causes the conversion value to fall. Therefore, bondholders should convert immediately to maximize value. That is all for our presentation. Thank you to our Business Finance 2 lecturer, Madam Suhaiza, for this opportunity, and thank you for listening.